That's a basic, the first fork in the road. No? So Fabian, can you tell us what would be the implications of those two models?
Yeah, pretty strong opinions on that. I think it's important that the foundations, the base layer, will be decentralized. Right? And if you look at today's world, when we talk about things like cell phones, iPhone, we have all of these discussions if it's okay for Apple to go to the App Store, as an example, similar to Google. That's just cell phone apps. And if we talk about potentially the future of digital economy, right? And you have a layer where there are stable coins up there, where the people exchange value, where they interact. This can be really dangerous. So I'll give you an example. If it's controlled by just one company, they could tax it, right? Yeah. And just expropriate rent from all the transactions on there. Or, I mean, we even heard that today already. At some point, if it's not profitable for them anymore, they could just shut it down. You as a business who has invested quite heavily in a place, you'll be left with absolutely nothing. That's not a good idea. So I think it should be, it must be.
Perfect. Thank you very much. And I mean, it's having a lot of impact. I mean, you just talked about some of very important brands, and now we talk about Apple. I mean, for which sectors is the metaverse going to be a game changer?
Yeah, I think, well, so when we look at the metaverse, it's the consumer metaverse, enterprise metaverse, and industrial. Industrial is by far going to see the most growth in 10 years. It'll reach 100 billion for the industrial metaverse by 2030. Right now, the curve is a little bit flat, but in 2026, you see it start to pick up and increasing pretty rapidly from there. So the industrial metaverse is around manufacturing, simulation, and prototyping. They're using it for factory optimization. There's a really interesting case with NVIDIA Omniverse, BMW's factory of the future. They have actually made digital twins of all 31 of their BMW factories across Europe. And they can use it to simulate the entire factory floor. And they can decide how humans are going to be moving alongside the robots on the factory floor. They can even look at how the factory workers are taking parts and adding them to the cars, like the impact on the ergonomics of the workers. And so obviously there are huge savings with doing this kind of planning in a virtual space before actually building it out in real life. But I will mention challenge. Lab just published a piece of work about the industrial metaverse in October, and they found two key challenges. One is the amount of connectivity needed to interact with factories in real time it's really, really high. So it needs to be like high connectivity, low latency. And also the 3D content data that comes out of these renderings is not compatible with I'll mention one, representing Accenture a bit, one really cool project that we have in the metaverse. Accenture is really focused on the enterprise space, and we use the metaverse a lot for training and learning. And my favorite project that we have is called Avenues. It's used to train caseworkers who are dispersing social benefits. Thank you so much. I'm coming now. And so by immersing the caseworkers into a virtual environment, they can experience the emotional, what social benefits they need and get the proper emotional training and support for themselves around that so that they can go be ready to speak.
Perfect. Thank you very much, Karen. So those were the building blocks, right? So let's talk a little bit about the future now, which the future can be right now. So, one of the things has to do with value, no? And we're going to cover that topic along the day. So, in Neil Stephenson's Snow Crash, we see that hyperinflation had eroded the value of the currencies, forcing people to rely on alternatives. Fabian, what drives value in the metaverse? For example, what drives the price of land in the metaverse? and how accurate are these projections, like the ones that Catherine gave us on the value of the metaverse?
I don't know anything about your methodology, so it's super hard for me to say if it makes sense or not, right? I think it's always hard to make these predictions. Maybe there's one point where we might slightly disagree on, and that's the definition of the metaverse. More on your side with that. I think the metaverse is really about the internet of the future, right? As you have mentioned it, where people interact in this 3D space. And what you have described, to my understanding, is more of a supply chain simulation. So you would not necessarily need a connected virtual world to simulate a factory, right? That's something we do at the universities. That's something these companies already did for a really long time. I think what the metaverse really is about, at least as I'm concerned, is that people can interact in this world, and it's kind of an interoperable place where people exchange value, where they interact, where they can buy land, and that's when we are at the value. I think what's super puzzling and what's interesting is that we have seen these land sales. And in some cases, people really spend millions of dollars for a parcel of virtual land. And this brought up a discussion why people would do that if it's something that is not really scarce, that you can just create out of thin air. Because if it's really an open standard, then people can just host their land on their own computers and have it in line with a certain standard and then link it to another world, right? That's the idea. And in a recent research paper we put out, we were able to demonstrate that what people are actually paying for is not the space to deploy their content, but really the location. Right? So it's basically an attention economy. And what you really want to do is you want to be close to main streets, to the starting points where people start their journey. So basically like train stations, or to be close to a district, like a fashion district. And we were able to show that this is actually driving prices.
Perfect, thank you. And I was going to say, Keith, that should be related.
And I can build on that a little bit. And we learned quite a bit with Samsung in Decentraland. We hosted their experience for nearly, and Fabian, I couldn't agree more, where that version of the metaverse is about the attention economy. And essentially you had speculators that said, we believe that this virtual world can draw daily active users in numbers that would reach an economy of scale that we can essentially commerce through this ecosystem, right? And so you look at someone like a Samsung, and when we had launched, there were tens of thousands of daily active users in Decentraland. We tapped into those tens of thousands of daily active users for experiences, and one of those in particular was we launched a brand new cell phone. We launched access to pre-order a brand new cell phone inside of that world. And so we knew we had a dedicated audience, tens of thousands of users. We knew we had that they had instant access to the crypto wallet that was also attached to their identity. And so this was, I think, probably more of a social experiment than a scalable experiment in the metaverse, but it was, could we reach eligible shoppers with the right amount of cryptocurrency in their wallet and put an experience right in front of them and make it accessible. And so that was really, again, that social experiment that we ran, that drove the value of that land. But as those daily active users declined substantially, then that attention economy essentially went away and the price of the land went with it.
Perfect. I think that complements perfectly the Fabian's answer. And so we return to this part on a big corporation, right? So who controls everything in this metaverse? Who decides what has value? Who decides what are the the costs of entering this ecosystem? And even whether Samsung could or could not advertise in that ecosystem. So Catherine, what do you think about those implications? Like what would be the foundations for a responsible metaverse? What should be the approach regarding data privacy?
Yeah, I mean, we absolutely want a world where individuals have power and agency. And so I think it's the foundation of a responsible metaverse is one that is building trust with the users. And the company that builds the highest trust with users is going to be where the most users enter and exist. So I think we need to make sure that users have self-managed identity and that they're in full control and ownership of their data, and that they can port their data from environment to environment. That's the kicker. I'm doing a project with the World Economic Forum's Digital Trust Initiative right now, and we're focusing for the first time ever on how to support individual agency. And we've narrowed it down to 3 key factors that technology companies can play. First is transparency by design. So this means that a user enters the environment and without having to read a long instruction manual or deep into the small print text of the consent mechanisms, they know how their data is being collected and how it's being used. That would be a huge trust building exercise. Number 2 is privacy by design. This has to do with the settings, the privacy settings that technology providers make. And there's, of course, going to be a temptation to favor the privacy settings in line with the revenue model of the company. But in order to build trust with the users, the privacy settings and defaults need to favor individuals. And this is important because there's something called inertia and consent, or inertia, where the users are going to keep the default settings as is because it's less effort. It's uncommon for a user to go in and change all their defaults, although there are really good resources out there that can help you do that if you're not sure which ones to choose. And then the last important factor is redressability. There needs to be a mechanism for users to go directly to the tech companies if and when something goes wrong, and those issues need to be addressed and fixed. And then if that doesn't happen, this is where the regulator community comes into play. What other backstops are in place? There's, of course, always the option of legal action through private right of action, class action, and beyond that, what other ways can governance beyond tech companies' self-governance ensure trust in the environment?
Again, do you want to compliment?
Maybe just a quick comment to what you said earlier. I think it's still an attention economy, right? Just because the prices go down, of course, on a lower level, but it can still be an attention economy. And regarding privacy, I think we will be in huge trouble if it's just controlled by one entity, privacy-wise. But to be fair, even on a public metaverse, it's not that clear that it's private. I'll give you an example. In a recent research project with Mitchell Goldberg and Dario Turkauf, we've collected data from Decentraland, which is one of the largest metaverses, where we have the movement patterns from all of the users. And then we combined that through the Web3 address with the Ethereum transactions and the Polygon transactions. So we are able to see where somebody is when they get engaged in economic activity, when they bought something. This is really powerful, and for me as a researcher, it's amazing, right? But it's also from a privacy perspective, a nightmare, because we're certainly not the only ones who are collecting that data, and there will most likely be entities collecting that data which are not as responsible as academic institutions.
Perfect. And I guess it has also to do with the interface, no? So you said location, but now one of the things of the metaverse is that you get to use AR or VR or some sort of instrument that actually lets you be immersive into that environment, no? And that can collect all of your data, no? So you can collect your heart rate and collect how your pupil moves. So I know that, well, of course, for an agency that would be perfect. You could target perfectly, your consumer and then sell them a specific product, no? But so how do you think that would be addressed?
Yeah, I mean, look, there's technology is affording us the ability to collect more data than ever, right? You mentioned things like eye tracking or biometric data. One, do we have the capacity to act on that today? I would say largely and at scale, no. And so I think we feel pretty good about where that data is going today. In the future, and certainly with the capabilities of AI and machine learning, marketers could action on biometric data at a more substantial scale. So today, I think you're relatively safe because of limitations. technology. Tomorrow, I think it's absolutely something to me, and you know, where we kind of sit philosophically in this as marketers, is if we're asking you to exchange more data than what is required by the application, there should be an even exchange of value back to the consumer. And so does that mean that you, you know, can essentially prove that you're a better customer, that can ensure more lifetime value back to the brand, and you want to reap the rewards of what that provability means? You may opt into sharing more personal data. I don't think that should be like Catherine was saying, at the bottom, at the end of some incredibly long terms and conditions. That should be incredibly transparent at the front. But that being said, there can be much more powerful applications of commerce if you do opt into sharing that deeper levels of data. So I think both of the use cases of what data is collected and the practical applications of using that data, as those grow, I think consumers are going to get the choice, and they should have the choice on whether they want to opt in to sharing that data.
Perfect, thank you. And I mean, it reminds me of Ready Player One, no? Like the whole point was at some point, then they would just clear your vision with ads, no, all the time. And one of the things of Ready Player One that I like very much, when they were jumping from planet to planet, and you could take your sword, and you talk a little bit about that, right? Taking your sword from a planet to planet and then being able to use it. So in terms of interoperability, what would be the foundations, you know, in the structure that needs to be in place so that the metaverse can be interoperable? Catherine, I think maybe, or Fabia?
Yeah, that's a good question. I think there's a conundrum. It's difficult to get full security, privacy, safety, and interoperability at 100% at the same time. And so I hate when people use the word trade-offs, but I know that businesses are struggling with how to ensure cybersecurity of a headset when people are using multiple companies' headsets. You only have jurisdiction over your own headset. And also, you know, like certain larger tech companies with more resources have more capability to conduct content moderation. And so that, you know, promotes safety, and they can't guarantee content moderation in another platform. And so while it is really important to be able to move your data from place to place, we're still working. I think it is an open question in the industry. You know, honestly, how do you promote cybersecurity, safety, and privacy and interoperability all at the same time?
Thank you very much. Yeah.
I think it's about standards. Yeah. You have open standards where, again, I can also host my own virtual land parcel on my computer, make it accessible. Then I think we come a long way. And the other thing that needs to happen is the assets should not be stored on a proprietary database. Right? And this calls blockchain. Right? If you have a public blockchain and you have the assets on there, then at least in theory, it would be possible to take them from one world to the other. Although in practice, to be honest, I don't necessarily see the incentives for, let's say, Activision Blizzard to implement the sword from Ubisoft. Right? Why would they do that?
Perfect, thank you. So we're running out of time for our panel. We went about pretty quickly, I know. But so to close, I mean, what I would like for each of you to tell us, what do you see in the future of the metaverse? What do you expect will be the important trends to follow? What should be we should be putting all our focus on?
Yeah, I mean, I think the trends to look for in the metaverse is really the convergence of three foundational technologies that are going to power the creation, the oversight, the management, the moderation. You've got extended reality technologies, which are going to power your view, right? What you see in virtual spaces, in virtual worlds. You'll have blockchain technologies or blockchain technologies implemented in these virtual worlds and virtual spaces, which may make the data flow around much more seamlessly and in a permissionless way. When we don't have keyboards and mouses in these experiences, and when they show up just on the street or walking down the street, you're not going to be able to type in your email and password and 2FA. we need a much better, more efficient system to move us around digital ecosystems. And then lastly, as you know, we say, oh, we need to consume more metaversal experiences because consumer demand goes that way. AI powers the creation of the virtualized experiences that can look different to you, that look different to me, that look different to Catherine, that look different to everyone that views it, maybe even at the same time. So as these three technologies grow, improve, and proliferate, and they start interoperating and working in orchestration, that's when you're going to see the real explosion of metaverse capabilities, metaverse technologies, and metaverse experiences in your daily life. So I think we're at the very beginning of an up curve, and I'm excited to see where it goes.
Perfect. Thank you very much, Keith. Fabian?
Decentralization and privacy. Yeah, I already mentioned why I think it's important, and these are really the two factors I think are what we should care about most.
Perfect. Thank you very much, Catherine.
Yeah, as someone who's currently working on projects related to wholesale CBDC, Metaverse, and AI governance, I love what Keith said because it is about, you know, the future of the internet is going to bring all of these technologies. And for some reason in my mind, I have like 2030 as a kind of milestone point where I think they are really going to converge. And we need new words and terms to talk about these things because your definition of the metaverse, I love, and it isn't the definition we were using a year ago. And even like in the projects that we have with the forum, each time we publish a white paper, we have to redefine the metaverse. But really it is the future of the internet that is three-dimensional and is underpinned by artificial intelligence and blockchain. And so I would say, we need to talk about all of these enabling technologies together and all at once. And really the challenges with each of them are the same, you know, same data governance. It boils down to a lot of the same principles. So let's bring it together and talk about the future of the internet.
If that's not Web 3.0, what is
5.0? I don't know.
Thank you very much. Well, thank you very much to our guests. I think we learned a lot about I think you have a broad vision of what are the important things to really consider, and then that way we can maybe next year we'll meet in the metaverse.
Yeah, let's do it.
Thank you very much. Now we move to
Here, my name is Sebastian Dörr of the BIS, and today's panel is about tokenization, how it works, and how we can make it work for all of us. And I'm quite fortunate to have a number of experts here to educate us on the topic. So we have Carmel Gede of MTech, who I think it's safe to say is a pioneer in helping design modern central banking infrastructure. Then we have Mathieu, who's basically a master of stablecoin and understanding it. So we hope to learn about that from you. Next week, Ito, for tokenized deposits. And finally, Fabian, who came all the way from Basel, for basically putting these things together. That's what I want to hear from you today. Okay, so let's just get started. First, Dante, I want to hear from you. At a very high level, what do you think tokenization can do for us? So what are the problems we have today in the financial system that you think it can solve? High level.
High level. Well, first of all, it's great to be here and great to be on this wonderful panel. So at the highest level, I think of blockchain-based technologies in financial services, particularly not as a disruptive technology, but as an augmenting technology. So the original narrative arc and the original positioning of this technology was that up to its own devices, it would democratize access to banking and payments and make Wall Street irrelevant and make banks irrelevant. And what we have learned, not through abstractions or theory, but as an operating company at Circle, is that without banks, perhaps so much of the innovation and technology would be the self-referential trading of JPEGs and I'm being a little bit controversial. This is meant to be hopefully a bit of a debate. But that with banks and with the opportunity to have an on and off ramp into the real economy, then you have all of these other use cases that would be made possible. Things that are not possible, for example, if to be banked hinges on brick and mortar, billions of people would be on the margins. Billions of people would still have very little access to low cost payments. And so the experience that we have seen in the 5 years of USDC, as just one example, is that if you enabled any basic internet connected device in the world to be a compliant payment endpoint, then all of a sudden you could have this Cambrian explosion of economic activity supported by these innovations. And that's pretty real.
So we here at JP Morgan, I assume you have a different view of things. So would you like to offer your thoughts on the same question?
Thank you. Yeah, so actually, we do have very similar views around tokenization. What are some of the benefits? But actually, what I'll add on to Dante's point is really on the deeper level, from a technical level, what tokenization actually means. So if you think about before blockchain and tokenization, essentially you have two models of recording value. One is the bearer instrument, what we think about as a token-based model, essentially like your cash. It's a bearer instrument in that, transaction takes place when you hand your cash to someone else directly. Ownership of the cash means ownership of the value. The other model is an account-based model where essentially you always have to go through to an intermediary like a bank, where you tell the intermediary, please update my records. The good thing about an intermediary-based model is that there's safety and security in that the banks perform payments controls like your fraud checks, your AML, CFT kind of processes. Tokenization to me is essentially the ability to bring the processing into a token-based model. So what it allows is the creation of a bearer-like instrument in that we are able to transact peer-to-peer directly with each other, but at the same time, we can have the processing logic built into it such that we can transfer in a safer and more secure manner. So to me, that is the benefits of tokenization itself.
So you're saying banks have a reason to exist. They're not just a nuisance that sucks away rent.
Definitely.
Okay, good. Carmel, so one area where tokenization promises help is financial inclusion. So you've thought quite a bit about that. So what do you think exactly we can make progress here?
Yes, so to build on what so far has been said, the idea of representing an asset going from physical form into what we would call virtual in this case, which is different from electronic. So we had this journey to electronic money, which a lot of people say, well, money is already digital. And an electronic form of recording an asset is very different from being able to not only represent that asset in a virtual world, but also transfer it peer-to-peer via various different channels. But when you think about the most used and common form of money that is being used today around the world, it is cash. And yes, the banks play an important role when it comes to providing the infrastructure and the onboarding and the trust that we have relied on over time. But cash is a very interesting asset. When you think about the legal tender role that it plays, it's very unique. The ownership, the bearer instrument by nature that it represents. But billions of people, especially if we're sitting here today talking about the remaking of the financial markets, how do we bring along the billions of people who are still using paper cash today? And I think tokenization gives an opportunity to take a physical asset like paper cash, represented virtually, and make it possible to transfer it via various different channels, but also devices. And one more thing that billions of people around the world who are using paper cash today also use are mobile phones. And how can we leverage technology in different ways in order for us to say the trillions of dollars of cash that circulates every day, through people who are making transactions for commerce, for families, for day-to-day purchases, bringing it in a virtual way, tokenizing it really presents an opportunity to do that in a trusted way. And of course, when you think about tokenization, it's not just representing the asset in the virtual world, it's also building characteristics that makes it an asset that everyone can recognize what it is, can trust it, can transfer it, can store it, can decide when to use it. And the velocity of that activity, I think, is almost impossible to measure, to be honest, when you apply different use cases around when you start tokenizing not only cash, but other assets, and you combine that.
So you mentioned trust in the central bank. And so Fabian, one thing I don't fully understand is what exactly do we need in terms of technology for that? Do we need a blockchain, decentralization, just a programmable ledger? So if you distribute cash to your citizens, does that have to be on a DLT-based blockchain? I mean, I know you have strong views on that. So
I think it really depends on what you want to achieve. Right? We have and already had the technology to issue digital money for quite some time. It's based on a centralized ledger. And there's certainly some use cases for that. Now, what's different now with tokenization is, of course, you can have self-custody, right? And you can be in control depending on how it is set up. We can discuss that maybe later on. But the other thing that's new is the atomic settlement. Right? And the idea that, let's say Alice has a blue token and Bob has a red token, and they want to exchange that. They don't have to go to an intermediary. They don't need an escrow agent, even if they don't trust each other. Right? They can simply have these two transactions as one blockchain transaction, and either both of them go through or both of them will fail. This can eliminate a lot of the counterparty risk, and it doesn't stop there. You can really have dozens of sub-transactions with one transaction, which is super exciting. Now, what people usually don't tell you, in order to achieve that, all of these assets and the protocols have to be on the same blockchain. Right? And this, of course, raises a lot of governance issues, because if the blockchain is controlled by Alice, then Bob will not be happy, and the other way around, right? And it's probably not a good idea to have this infrastructure under the control of just one person. So long story short, I think really to achieve that, right, and to get all of the benefits from tokenization, the base layer must be decentralized.
So please hold that thought, because I'll get back to you on how to integrate all these assets. But before we get there, maybe we can understand what the assets exactly are. So Wiki, tokenized deposits could be one element of the future monetary system. Could you explain intuitively again how they would work, why we need them, and who would provide them?
So before I start, so from a terminology perspective, actually, we do prefer the term deposit tokens rather than tokenized deposit. And I can explain a bit more why. So if you think about from a bank's perspective, a deposit is a general liability of a bank. So if I go to a bank with $1 in deposit, the bank is obliged to give me $1 back. So, but when we think about tokenized assets, generally what you are looking at is an asset is immobilized by a custodian, and a token version is issued representing a claim on the underlying set of assets. Now it becomes a specific liability, and because of that, it doesn't act in the same way as a general liability of a bank, which is a deposit. Which is also why generally we prefer to use the term deposit tokens, especially because we are able to natively issue these deposit tokens very much like we can have deposits for our customers. So how it will work is that a customer essentially, transfer us $100, we'll provide them with $100 worth of tokens in return. And about why these tokens are useful is very much like what Fabian was mentioning. The fact that on the platform itself, you now have a native on-chain digital value that you can use for transaction. A lot of interesting things can then happen, like DVP, atomic settlement. And Fabian, about your point about how difficult is it to bring multiple parties together to share a platform, I do feel that that's really where blockchain technology provides a certain set of advantages. So what we do have live today is what we call Patio, essentially a multi-bank setup where banks run their own node and have a shared ledger where we are able to record each of our liability. And for our participants, that means that they can transact in different currencies directly with each other. you start to get very interesting things like on-chain atomic settlement for FX. So these are the kind of benefits that we get once we are able to have this form of a value on a common platform.
Okay, let me get back to that once more. So if I wire money from my account at my bank to your account at your bank, then will there be a token transfer, or will my token not be transferred to you, but you get a new token from your bank? Right, so is this the same token or not? Because if I wire a deposit to you, I have a claim on my bank and you have a claim on your bank. It's not the same token. So I will just make sure that we're understanding.
So the way we look at deposit tokens today is, as a first step, we are going to issue it to our customers. That is the easy part of it. The next step is actually where it gets a bit trickier. So for example, I do have a network, a large network of respondent banks, essentially as part of our correspondent banking network. So for example, a bank in Singapore could be using JP Morgan for US dollar, clearing. So a customer of DBS Bank, for example, one of the banks in Singapore, could they hold a deposit token that represents a direct liability of JP Morgan that allows them to transact directly with someone else who's also, a client of a respondent bank of ours? So that is where we start to see a lot of the value from the ability to do direct peer-to-peer benefit, peer-to-peer transfers. But from a regulatory framework perspective, there are questions that we do need to sort out before we can move to the level where it becomes very much like a bearer-like token where different parties can transact directly with each other. From a bank perspective, one of the most important things is that we do have to make sure that from a payments control perspective, your AML, KYC, CFT kind of processes continue to take place even when we allow such kind of transfers. That is really the difficult part of allowing for direct transfers, across banks using deposit tokens.
Okay, thanks. So Dante, deposit tokens and stablecoins are sometimes pitched as rivals. Now you've played an important role in developing the stablecoin USDC, and so many of the issues that Wiki just mentioned probably apply to USDC too. So how do you see the relation between deposit tokens, stablecoins? Are they rivals? Do they coexist? What do you think are the inherent benefits of stablecoins?
Only because I'm in polite company, and I have to actually have the rivalry with Umar Farouk on the stage in Singapore FinTech Week next week. So I'll spare my daggers. There's something to be said, obviously, for an existing world scale payment stablecoin product, right? That tells us a little bit about this point I made earlier, that the technology itself is an augmenting technology, not a disruptive. And that without banks, the extensibility of this product and the availability of on and off ramps and liquidity and the rest wouldn't be possible. So I speak with deference about this. Where banking stops and where brick and mortar banking stops is the role and the biggest opportunity for payment stablecoins and blockchain-based financial services to begin. But they have to respect each other as a part of a value chain. And so today, USDC is available in 191 countries, courtesy of the fact, and these are really important takeaways. Number one, a Google spreadsheet on Amazon Cloud is not the same thing as a public blockchain. The total point of all of these innovations is about overcoming the idea that all technologies in financial services are proprietary, right? Most major global payment systems are merely making marginal improvements in debit and credit instructions, and so they're messaging platforms. They're not platforms for transmitting value that is always on at internet scale, at internet speed. And I realize I have my friend Tony McLaughlin here with the Regulated Liability Network in Citi. Those are important innovations, but those are going to be intra-bank networks. If you want peer-to-peer world-scale payment systems, then you need a category of digital bearer instruments that are transmissible between the two of us without asking for permission. And it's hard to envision a world in which a deposit token or a CBDC would be permissible to transmit outside of walled gardens. And so if you care about financial inclusion, you also have to care about open, non-proprietary technology and financial services.
So I agree that having a better, say, IT system, be it an Excel spreadsheet or a blockchain, makes the world, better, faster, more efficient. But so, part of KYC, AML, those are costs because you have to verify that stuff. If you just don't do that, I know things get more inclusive, but I'm not sure that's the answer. So I guess the question I'm having is, if you really have to comply with all of that, can you still make the same claims? I just want to know.
Yeah, no, for sure. And as it happens, I do. I'm a regulated company inside the United States of America. I have 48 state money transmission licenses. I have the very first BIT license ever offered to any company in the country, and I'm a money services business with FinCEN. So I do, and Circle does comply with all of the requisite rules as any other payments company would. The distinction, however, is that we can get into a conversation of risk reduction to absurdity, where any digital asset in any wallet should be KYC'd, and the obligation is on the issuer of the digital asset, or we could acknowledge the value chain. And if an individual custodies their digital assets in a KYC'd wallet or in an individually hosted wallet, then they have no other protections beyond the ones they could afford themselves. And on the other hand, there's this entire world of the very first globally harmonized set of rules for crypto assets are FATF Recommendation 16, which is about travel rule conformity and all the rest. And so you could envision this really working exponentially better than the alternative, which is to have billions of people marginalized because of the cost of de-risking, and the post 9/11 financial crime compliance framework has not had any updates. So I think we could do financial crime compliance better and micro-target the bad actors as opposed to penalize entire continents. Something I know Carmel cares about deeply as well.
Right, that's more a critique of regulation than the method of doing it, but point well taken. Okay, so you already mentioned CBDC. So Carmel, stablecoins, deposit tokens are private solutions. In today's financial system, central banks matter, and probably more than ever before. So how do you see the role of both wholesale and retail CBDC, and how would they interact, if you think so, about stablecoins and deposit tokens?
Yeah, I think the question around how the different deposit tokens will settle across different banks is a very interesting problem. In my previous life, building a platform for different commercial banks to tokenize their deposits through a common platform and settle across themselves was very, very difficult. It's one thing to figure out the technologies, another thing to figure out the governance, and then make everyone kind of play together nice and agree to take each other's tokens. That's why you have ACH, that's why you have RTGS systems and so on, which leads me to retail and wholesale CBDC. I think if you think about the value chain of the financial market infrastructure, the role of central banks is to provide that trusted currency, sovereign currency, that can run through all of those channels. The second tier into the private sector will always have some level of silos, just because business and the incentives are different and aligned when it comes to having private tokens, and they want more of their customers holding their own tokens for longer. And if you understand the commercial banking business model, that I don't think that's going to change with deposit tokens. So one use case for retail CBDC, for example, today at the bank, if you want to take money from your JP Morgan account and go and put it into Citi, one way of doing that is writing a check from your JP Morgan account and then go into your Citibank, deposit that check, and then Citi takes it and then clears it through the ACH and the mechanisms. And there's a system where all the banks are plugged into a system where the plus and minuses happen. I think you could see something like this as well with retail CBDC, where users want to convert their deposit tokens or token deposits into retail CBDC, and every regulated or every bank would accept a retail CBDC because it's cash. That's one way of providing a bridge between the two. On the wholesale CBDC, one use case that's very interesting, actually two use cases. One is being able to provide a modern take on reserves when it comes to stablecoins and when it comes to capital market settlements. The T+2 mechanism that really locks in a lot of funds every day could provide a lot of liquidity into the market. So having a compatible central banking infrastructure to match the private sector infrastructure when it comes to tokenization can provide a lot of value. And then cross-border payment. I think there's a lot to be said about how you can rebalance, and I do care a lot. I'm originally from Haiti. This is why Dante mentioned that. When it comes to emerging markets, The currency fluctuation issue that exists in a lot of emerging markets, tokenization is an untapped technology when it comes to providing more clarity, more transparency, and bringing more of cross-border payment on-chain and digitally to provide more access to FX and US dollars and a safe method that can address some of the de-risking, some of the concerns and lack of data and lack of clarity around AML and KYC, but also replenish reserves in a healthy way to support trade and stabilize more currencies. I think that could be very interesting.
Okay, so Fabian, that's the perfect question for you then, basically. So we have three assets now: central bank money, tokenized deposits, deposit tokens, apologies, and stable coins. And so as Carmel mentioned, they eventually will have to speak to each other to really make this work. And so my question is, what do you think is the way to find a common standard, make them speak to each other? You know, you mentioned a blockchain, but who would provide it? How would you agree on one? How would you get JP Morgan to adopt your blockchain on your computer? And so I think that's a big challenge, but so please.
I mean, I have an opinion on that. It might be very unpopular in this room. The opinion is there already is a standard. Regulators are just late to the party. Right? I mean, whenever you go to policymakers, regulators usually say, yeah, now we need standard setting bodies and we need to make sure that it's interoperable. It is interoperable. Everyone is using the ERC20 token standard. When you look at blockchains, pretty much anyone is using the EVM, the Ethereum virtual machine. So these standards, they emerged naturally in the absence of a standard setting body. And of course, the three things you mentioned, from an economic perspective, they differ a lot. But technically, the way you put them on a blockchain, you can do it in the exact same way. You use the ERC20 token standard, and then you build restrictions on top. This might be something super important for regulators. All of the restrictions you have in mind, in theory, can be implemented on the token contract. So a token is a smart contract. And for example, if you require that a token can only be transferred if people are whitelisted, you can do that. At some point, it just doesn't make any sense, right? At some point, you break composability, and it's just not a good idea to do it, but in theory, you can. That's why I always say, if you want to regulate certain assets, you do that on the token contract and with the issuer, and certainly not on the settlement layer, not on the blockchain.
And the governance would then be done by who? Just the people running the blockchain?
Yes, absolutely. I mean, why not, right? Why should it be an institution? Why is it a better concept to say it's just someone in control and have an open, permissionless blockchain? That's all the innovation. I mean, if you want to get rid of that, if you say we want to have somebody who is in control, then you don't need a blockchain. Then do it in an Excel spreadsheet.
I disagree.
Sure, please. I was thinking so. Okay, so I'm going to offer everybody of you to respond, but let's go from left to right,
all right,
please.
Sounds good. I mean, there is a difference between the actual running of a protocol versus the configuration of a token and the governance of a token, especially when it comes to CBDC, which is my world. I'll let Dante take on the stablecoin aspect, but a central bank will want to have governance and control over the rules of a particular token, and they can use a public protocol to run the ledger. What I like about what the new protocols are doing, it's very difficult to run nodes. It's very difficult to deploy and have governance be done by multiple conflicting institutions and come together to come up and run a protocol. There are certain protocols that's how they run. But you have certain protocols that make the ledger a utility and can run in a decentralized way while you control the governance of your token, which is the most important part.
But that's exactly what I said. I mean, I have to respond to that quickly, right?
Because 20 seconds at most.
Yeah, like I tried. I mean, you would regulate that on the token contract again, and you would regulate the issuing entity, but you don't necessarily have to have control over the blockchain itself. That's a very important difference.
Dante, Wiki, quick comments?
Quick comments. It sounded like I was invited to restart the Libra project, so I might have to go dust off an old 2019 white paper.
I would say that from a bank's perspective, right, it's very difficult to use a public blockchain because from a risk management, technology risk management perspective, there are questions that we just cannot answer today. So what happens if the blockchain goes down? What happens if the blockchain splits into different network again? What happens if that public blockchain, what are SLAs? You know, typically if I'm using a cloud service provider, there are certain set of governance SLAs that makes it easy for me to deploy my technology applications on their infrastructure. I think of a blockchain, a broadly accessible blockchain as a similar concept. The only thing is that with a public blockchain, the governance perspective are very difficult to answer, which I think when BIS, when the general manager, Augustine Custance, talks about the unified programmable ledger, perhaps that could be something that is run by financial institutions with a governance framework that is much more, makes it a lot easier for financial institutions to deploy our applications. Thank you.
So I can see you're all in agreement, obviously. I like that a lot. So I have many more questions, but I'm also Swiss since a year, and so I get very nervous when time is up, and time is up. So please, everybody join me in thanking the panelists, and I hope we all learned something today.
Pleasure to see you back. This morning we had lots of dirty work done, workshops, touching the small cryptos, and now we will be talking about big, well-established financial market infrastructures. We have 4 star speakers, which are sitting next to me. Very happy to present you David Nunes, CEO of SIX Digital Exchange, traveled here all the way from Switzerland. From Brussels, we have Peter Kerstens, who is advisor of European Commission. So not only private market players in this panel discussions, also policymakers as a regulatory bootcamp. Jennifer Peeve, she didn't have to travel from far away. She is representing DTCC. She is managing director, global head of strategy and innovation. That's correct. And last but not least, from London, City Treasury and Trading Solutions, Tony McLaughlin, apologies if I pronounced wrongly, managing director, responsible for managing payments and business development. That's right. This panel today will discuss how emerging distributed ledger technology could address the pain points of financial market infrastructures and their users. And in the first round, we want to take stock of cutting-edge projects which are working to build viable use cases using DLT. So it will be our first round. The second round will be to see how we can scale up those solutions. What's stopping us from really building not only viable and technologically viable use case, but something that is being actually used across widespread use cases. And in the end, I want to leave at least 5 minutes for your questions. So without any further ado, I would like to ask David how SIX Digital Exchange is using DLT, how it's different from other technologies used by traditional financial market infrastructures, what kind of benefits you can get out of it.
Thank you very much indeed. I'll take your one, yes. Okay, well, to give it in, just to sort of get some understanding of sort of audience appreciation. So who here thinks that we'll see security settlement on the regulated blockchain infrastructure happening in wholesale CBDC this year? Hands up. The guy from Switzerland and the guy from the city in London. So yes, we will, because SIX Digital Exchange announced with the Swiss National Bank last week that we'll be running from the 1st of December through to the end of June next year. Our primary market issuance is settling in wholesale CBDC. So it's kind of interesting to see just how our press releases aren't really making it out there into the public as effectively as we could do, and I'm not surprised that the Swiss National Bank is getting frustrated about the lack of recognition by the rest of the world as to just how far we've come in Switzerland in terms of building out our digital market infrastructure there and the sort of the tokenization and crypto side of things as well. But SIX Digital Exchange is part of SIX Group, which is the financial market infrastructure provider for Switzerland. We run the stock exchange and the CSD and the payments platform and a whole host of other things, the repo platform and so on. SIX Digital Exchange itself is an initiative within SIX Group, which was started in 2018 to build out a regulated financial market infrastructure on blockchain technology. And we got our license to operate a CSD and an exchange, and that's like the standard licenses, not special crypto ones, in 2021. And we did the first ever bond issuance on regulated financial market infrastructure on blockchain technology in November of that year. And since then, we've been building and building and building the technology up and the capabilities of the platform. As of the end of the year, we'll have something in the region of 18 members of the platform, which might not sound a lot if you're thinking about crypto, but we are intermediated dematerialized securities. So that means you have brokers and custodians on the platform rather than retail users. So actually that's quite a lot. And that represents about 95% of the entire investor community in Switzerland. So pretty substantial. And we've done a number of issuances in the fixed income space, now also in the equity space on the platform itself. And one of the reasons why we are is because we are actually in production. We're not a set of experiments. And I think one of the interesting things about this panel here is we're talking about getting DLT out of the sandbox, and we've never been in a sandbox. We've always been in production and leveraging. Yes,
but so what's value proposition then of using DLT? Why did you need to use that?
So why because well, first of all, we have a thesis, which is that that digital ledger technology will be the underpinning infrastructure of capital markets in the future, and therefore it's probably a good idea to kind of start building out on that technology, understanding what it means and how you can benefit from that. We also had some clear use cases from the outset, and it's been mentioned before, atomic settlement and so on, enabling sort of the reduction of risk associated with transactions and settlement, but also the automation that comes with smart contracts, which we already do as well, and on top of that, sort of the ability to do things like exciting use cases around immobilization of collateral for repo purposes or for funding in general.
Thank you, David. And when we move across the border from Switzerland, we are almost always in the European Union. So I turn to Peter from Brussels to talk about DLT pilot regime. It's sort of a regulatory sandbox to test DLT use cases. It came into effect only half a year ago. So could you please briefly tell us about the main idea behind this and the activity so far?
The reason why we proposed the DLT pilot was that our existing regulation governing financial market infrastructures either explicitly required or at least assumed the use of centralized technology. So you needed to use a central security depository. You needed to use a trading venue operating on a central ledger or central trading hub. Clearing and settlement often required centralized ledgers. And myself and my team, I am a DLT maximalist, so I will actually disclose that interest. I'm a DLT maximalist. My colleagues call me a madman, which I think is a synonym for it. And I'm firmly of the view that if we didn't have any financial market infrastructure at all today, and we had to start building it from today, it would be built on distributed ledgers. Because there is no good reason why you would want to set up a number of vertical silos that require constant reconciliation and constant paper pushing. So conceptually, distributed ledgers is the way to go for this infrastructure. But of course, we're not starting from scratch. We have an entire industry, an entire infrastructure and regulatory system that's based around centralized infrastructure. And that infrastructure is not broken enough to replace it immediately. It has good sides, it has some downsides, but it's not that we're going to do away with it, just move without any consideration to DLT. But we wanted to give DLT opportunities in capital markets in the European Union, because most people are focused on crypto assets that are not financial instruments, but that's not really where the market sits. People are not really that interested in it. It is the use of distributed ledger technology in traditional financial markets where, in our view, the business really sits, along with non-financial applications. And so we proposed the DLT pilot regime, which is effectively an exception regime, or sandbox, if you want to call it, basically allowing firms to derogate from existing rules so that they could test distributed ledger technology in financial market infrastructures, central depositories, in trading venues. Now, I must say that there's a big difference between the original concept which we had, which was let's give this a try because this is very promising, and what the European Commission as an institution proposed. Most of my colleagues think it's crazy. So they put a lot of barriers to the testing, a lot of limitations to the DLT pilot. And then when we moved to our legislator, the European Parliament and the Council of Ministers, our member states in particular, but also the European Parliament, where there's a very strong influence from members of member states that have strong financial market infrastructures didn't want us to sort of open up this space so that new market entrants could start disrupting it. So the DLT pilot, yes, is a sandbox. It allows for the testing of DLT technology in financial market infrastructures, but it comes with a lot of conditions.
So, Peter, if I may, it's a compromise that leaves no one happy in a sense.
It's indeed a very good compromise, and most good compromises leave no one happy. But so it's been in operation since half a year, and I'm starting to worry a bit because we have a 3-year midterm review, at which stage we will take stock as to how it's going and whether we should prolong it, should stop it, because this thing has caused the end of civilization as we know it, so we should stop it, which I don't believe. Or we should just say, this is the best thing since sliced bread. We should just make this the default. But in order for us to do this midterm review, we need to actually have live cases in this sandbox.
And as of now, there are none.
There are none. There are a few applications, but these applications have not yet been approved by our regulators, who are...
They like to think a lot.
Sorry?
They like to think a lot.
They like to think a lot. Let's say that among the regulators in this world, and BIS groups a lot of them, there are not that many fans of distributed ledger technology, let's face it. And that sort of limits also the degree to which they are willing to give this a try. So we'll see. I hope that soon we will have cases going live so that we have something to evaluate in now 2.5 years' time. Because otherwise, the evaluation is not going to be very interesting. What we have seen in the meantime is that the DLT pilot is a European regime. It allows companies to test on a pan-European scale.
Yep.
But what we do see is a number of companies testing DLT in financial market infrastructure, but they're doing it at a national basis. So they do bond issuances, bit of equity issuances, but they really don't sell it pan-European basis. It's within a given country.
But if I may just jump in as a moderator, so they will be doing it in a national jurisdiction, but later on they will spill over to other jurisdictions as well. So it's maybe just a matter of time. Peter, if we may move now to Jennifer. So DTCC is a well-established financial market infrastructure, of course. How do you use DLT? How do you approach? What's your role? Do you have any projects to test it or use it in real-world examples?
Out of battery. Thank you. So something that you said, Peter, struck home with me because it's been part of our mantra over the last several years, which is where there isn't infrastructure today makes a really good use case for blockchain. And the other comment I think that came out of what you were just talking about that struck home with me was, I wish everyone would stop thinking that it's an all or nothing proposition with blockchain. I feel like there are going to be opportunities to leverage this technology. There might be small opportunities in the near term that over time might become more and more attractive to different clients, different levels of the value chain and different parties in the value chain and regulators and policymakers for that matter. So I think that all of this is going to take time. And I think I wish, again, I go back to, I just wish everyone would see that there are absolutely some use cases for this technology. It will not replace every single thing that we do in financial markets, probably not in my next 10 to 15 years in my career. But over time, like we're gonna, people are gonna get more and more excited about the value that they see from this. And when I think about the work that DTCC has done, and by the way, I applaud everything that David and his team and the regulators in Switzerland have done, because they've really been able to demonstrate how to use this technology and start to build credibility and confidence in it. And we have not had that same opportunity in the US. And we have done some very small pilots. We have implemented parallel systems on a very lightweight basis, but we've not been able to truly get an end-to-end business use case up and running. And I think right now we at DTCC are working towards that. I think there are some very important things that we've recognized over, again, the last 2 years, one of which is FMIs are going to, I'm going to say this, I don't know who's in the audience right now, but I'm going to say it anyway. FMIs are going to drive this technology and its use forward. Technology companies are not. They're going to be great partners for that journey. They're going to add and drive innovation thinking, but FMIs are going to be the ones that drive that forward. And the reason for that is our markets work so well today because we have standards around protocols and how we operate, not just technology standards, but we also have legal and regulatory, we have data standards, et cetera. And all of those things need to be laid out such that we can build confidence in not only the people who want to use these solutions, but also with our regulatory community. So right now our focus has been on, getting collaboration and folks to start to think about how do we want to look at these different assets across various different angles, and what do those protocols need to be. We're never going to get harmonization 100% across every jurisdiction or on a global basis. We don't anticipate that. But our markets work so well today because we do all agree on certain standards and protocols and how they operate, how they create efficiencies for us. That's the first thing. The second thing is finding use cases that have real value. And I just mentioned, and Peter talked about no infrastructure. We spent some time 1.5 years ago looking at private markets. This is a place that needed some infrastructure, and with infrastructure could have some very interesting opportunities for secondary markets and liquidity. That still remains an interesting opportunity. It might even be more interesting around private credit these days in terms of just the asset class itself. But those are still places that we think are very interesting to follow through on with this technology. And one very small use case that we're working with some asset managers and fund administrators on right now is just around NAV data. Using blockchain for the dissemination of price and rate data around NAVs. To help solve for some very simple things. Asset managers sometimes send out upwards of 6,000 emails on a daily basis to distribute their price and rate information to downstream clients. It's public information. Why not leverage blockchain to help disseminate that data across a broad set of participants where they can access that data when and if they want to. So thinking about ways to leverage this technology to do very simple things can also help drive some innovative thinking in those client segments where they then start to say, well, if that works, then what else can we do with regards to our mutual fund businesses? How else can we generate some efficiencies in that end-to-end? And the last thing I'll mention, the third angle of how we want to experiment and how we want to, again, eventually get out of the sandbox, but it does require us to spend some time right now working and collaborating with not only our global FMI peers, but also with our clients and doing that all through leveraging our control framework. So looking at the risks involved in launching any new product, right? Forget about technology for a minute, and then thinking about what your mitigation for those risks are, and then applying that to your experimental, if you will, pilot or use case, so that you're demonstrating along the way, not only how what we want to do will be regulatory compliant, but also how the clients are going to get value at the end of the day.
Many thanks, Jennifer, for putting down-to-earth approach also to the innovation. It's not only about grand visions, but about how we can use new tech to solve old and maybe small, but day-to-day dull problems. Turning to Tony, I know that Citi, alongside with other industry participants, are participating and experimenting with a so-called regulatory liabilities network, which is, quote, a vision to upgrade sovereign currency systems with shared ledger technology. What is shared ledger technology? Why don't you call it DLT? Is it different? Did you try to avoid using DLT? Didn't you find it helpful to use that technology?
Yeah, thank you. Good questions. Good questions, I think, might be the theme of my answer here, which is, what is a good question for a regulated entity to ask itself when confronted with a novel technology like blockchain? And I think a great way into that is to realize that blockchains were not invented to augment traditional financial services. The original blockchain thesis that you can find in the Bitcoin white paper or the Ethereum white paper, this idea of what you might call the strong form of the tokenization thesis is ideologically opposed to the sovereign currency regulated financial system. It's a world in which you have non-sovereign currency units like Bitcoin, which are non-liabilities. Bitcoin is not a liability in contrast to a dollar, for example, where you have trustlessness, censorship resistance, anonymous or pseudonymous transfer of value peer-to-peer without reliance on central banks, without reliance on intermediaries, and the system built upon tokenomics. That is the original tokenization thesis. And none of that applies to regulated financial services. So a huge question is, why do we think that something built to overturn our system can be used to augment our system? Now, if you discard all of those features, which by the way would have Vitalik Buterin or Nakamoto aghast, because that's why they built the system. It's the ideological essence of why they built the system. If you discard all of that stuff and you ask yourself, nevertheless, are there still features of DLT or shared ledger or blockchain that would be attributes we can import into regulated financial services? There is still a subset of interesting features. Now, this subset of interesting features is not the strong tokenization thesis. You might call it the weak tokenization thesis, a very much reduced and curtailed and constrained tokenization thesis. And the question there is, can we take, let's compare Ethereum with traditional finance. Ethereum is always on, traditional finance is not. Ethereum is multi-asset, traditional finance is not. Ethereum is non-siloed, traditional finance is very siloed. In Ethereum, you really have this great capability, which is that of a state machine. And a state machine means you unambiguously know the status of a transaction. That's not something we have in traditional finance. So can you take those limited set of features in the weak tokenization thesis and apply it to regulated financial services? And that is the regulated liability network project, which we are trying to conduct with as a public-private partnership with multiple firms and get some answers. Now, I just want to illustrate how different these worlds are. Do you mind if I just get this one final thought out? Okay. This final point, how different these worlds are. This morning, when folks, and I know there's a lot of regulators in this room, were playing with the crypto and making the transactions, and gas fees were paid. A portion of those gas fees were paid to sanctioned entities. So on public chains like Ethereum, any computation or storage requires the payment of gas fees to the validators. You can't pick your validators. There are validators on the network who are sanctioned entities. So all of us this morning contributed towards payment of gas fees to sanctioned entities. And that shows that there's an enormous ideological divide, an enormous practical divide, an enormous legal divide between the mindset of public permissionless blockchains and the original tokenization thesis and what we're doing in regulated financial services.
It seems as a different paradigm. So now that we have only a few minutes remaining, I also wanted to turn to the audience and to make this a little bit more interactive. So we had an idea to have a second very quick round to ask our panelists about what needs to be done to make the widespread adoption of DLT faster. But maybe you also have questions that you want to pose, so I would encourage you to do so. While we're waiting for your questions, I have one question for David. So it was either you or one of your colleagues, I think in one of the workshops or conferences in the recent months, and it was said that it may take 10, 15 years to see widespread adoption of DLT in capital markets. Why so long? What stops if you have all the licenses, technology, everything is working in your exchange as you presented? What stops from faster growth?
So there are. Does this work? It works. So there is a. Well, I think the first thing is that I think, as my fellow panelists pointed out, there is an existing capital markets infrastructure in place today, which is very efficient, which does have some limitations, but which represents not only a significant amount of sunk cost, but also a lot of opportunity for revenue generation even in the inefficiencies that exist today. So even in the T+1 or T+2 settlement cycles, there's money to be made, whole billions of dollars to be made in various services that take advantage of that or enable it to be used in a positive way. So there's first of all the fact that there is this inertia within the market because there is that disruptive technology like this requires significant investment. That investment can be going to other projects, and the realization of the benefits is going to take a significant amount of time. So it's a hard sell from that perspective. It is definitely a marathon. So, and at the same time, there are key components that need to be put into place to actually enable adoption to happen. So I think we've done a lot of them here in Switzerland, including right up to getting the CBDC, the riskless settlement asset, which for a capital market ecosystem is really important. But there's still plenty of other things. There's plenty of other steps we need to take as well.
Thank you, David. And Jennifer.
Can I just add one thing to that? I think market structure change is also something that I think is challenging for people to get around. So you can design a solution that looks exactly like what we do today, but that's not really helping us. That's not using the value of what this technology can do for us either. And so some of that does mean that the roles of individuals or firms will change. The number of firms involved end to end will change. And so getting some of the participants around any table in these discussions, that's also a very difficult, that's also just a difficult concept for them to get behind, because everyone has revenue, businesses that revenue generating businesses behind it, right? So that I think is also important to mention.
Yep. Peter, please.
I do agree that this innovation, if it ever is to see the day of light, will be driven by the financial market infrastructures. And you have to ask yourself the question, what is their interest in going wholesale to DLT? Because that's going to kill the goose that lays the golden eggs. So quite a lot of intermediaries currently are making an awful lot of money from exploiting inefficiencies. There's something quite peculiar in the economy, in the financial economy, is that things that don't work efficiently, you can charge money for. The things that go automatic, you can't charge anything for. So you need to have some friction points to make money of. And so if they figure out a way to make money of this, they'll move. Because currently, who is making money of DLT? It's indeed the validators, the miners. These are not the traditional financial market infrastructures. These may be sanctioned entities. They are making money in this. But if we get there, if they find a way to make money of this new environment, I think, and more money than they currently make, I think that we'll see things going more quickly. The second thing which is absolutely necessary for this to pick up is secondary market trading also needs to be on ledger, because there's no point in doing an issuance of tokens if then the secondary market is not tokenized, if there's no cash on ledger, if you can't transact. That's what you need. You need to have what they call atomic settlement, sort of changing securities for cash proxies, I call them, stable coins, central bank digital currency, what have you. Once you have that, you're in business. But that will take away a lot of what you currently see in financial market infrastructures. There's no need for clearing and settlement anymore, because the clearing and the settlement is part of the same transaction as the actual trade.
Thank you, Peter. And unfortunately, our time is getting to a close, and it's time for me to conclude. So today on this panel, we had DLT maximalist, we had DLT realist, we had DLT minimalist. what the future holds. Maybe in the future, we will all be GLT users like David. Thank you, everyone.
I think that we're ready to start. So welcome to this next panel on the experience with central bank digital currencies and fast payment systems. So fintech in general, I think, and digital payments in particular, bring together a lot of different disciplines. It brings together finance and technology, notably. It brings together the public and the private sector. It brings together, technologists, innovators with public sector authorities who have mandates for looking after public policy and the public good. But we've seen in different countries, radically different levels of adoption of digital innovations and digital payments. So in some countries, it's already a majority of adults that are using digital payments, different types of systems. In other countries, it's still, much earlier stage. One pattern that we do see is that digital payments adoption in particular is more advanced in jurisdictions in which there are digital public infrastructures. And there's two types of infrastructures in particular that are very notable and that have gotten a lot of attention. And these are central bank digital currencies, which we've heard about in the last few panels, and also retail fast payment systems, many of which are operated by the central bank or by private entities with a strong oversight role of the central bank. And so today we're going to hear from some of the international experience with these two initiatives. And we're very happy to have a very international panel with perspectives from really around the world. And so I'll just briefly introduce our panelists before jumping in. So we have Sharon Branch here is from the Central Bank of the Bahamas. She'll be able to talk about the Sand Dollar, the world's first live central bank digital currency that was launched in 2020. We have Musa Itopa Jimo from the Central Bank of Nigeria, who can talk about the e-Naira, again, a live central bank digital currency, which I think is very exciting and very interesting, and we'll be able to hear more about. We have Robin King from Payments Canada, who will talk about the real-time rail, the fast payment system that's due for launch in 2024 in Canada. I think also very relevant. We have Ricardo Mourão from the Central Bank of Brazil, who will be able to talk about PIX, the Brazilian instant payment system, as well as the Digital Real project. And we have Aaron Klein from here in Washington, from the Brookings Institution, who will also be able to talk about some of this perspective and how it relates to the United States, which I think is a very important aspect to dwell on. So without further ado, I want to launch in, and I just wanted to start with Sharon. And of course, the Central Bank of the Bahamas launched the Sand Dollar at CBDC 3 years ago now. We wanted to hear from Sharon, first of all, what were the primary motivations for the Sand Dollar? What were the challenges integrating the Sand Dollar with the commercial banking system? And what do you see for the path going forward?
Okay, good afternoon all. The primary motivation for us introducing the Sand Dollar centered around financial inclusion. For those of you who don't know, Bahamas, we're archipelago. We have 700 islands and keys, and some, the population is very small. So the issue arises that some of the banks, they found it not too costly to operate, and they decided to close the banks. So there was a void for persons on those islands. So in order for us to, the central bank decided in order to address the issue and to make banking services available to those outer islands mainly, that we launched a central bank digital currency to address the issue. And so that was basically the motivation in terms of financial inclusion, addressing the challenges that they encountered in terms of the banking issues. So we have it four main objectives that we're targeting: to increase efficiency in the local payment system, to provide non-discriminatory access to financial services, and to achieve greater financial cost effectiveness, and also to strengthen national defense against money laundering, counterfeiting, and other illicit activities. So in launching of the Sand Dollar, we have it in 3 tiers. Tier 1, it just requires you to have a phone number. So if you visit the Bahamas, you could just go to one of our authorized financial institutions, give your phone number, and they can onboard you, and then you could put money on your Sand Dollar, and you can use it at the institution, the different supermarkets and those and stores that accept Sand Dollar. So that's tier 1, just a phone number. Tier 2, and the limit for tier 1 is $500. You can top up to $500 on your account. Tier 2, it's a little higher. The maximum top is $8,000, but it requires you at least one piece of identification for you to be a tier 2 customer. And tier 3 is basically for businesses with a $10,000 limit. And that would require you to produce your business license, your VAT identification number, and a few other pieces of documentation. If you're in the tier 3, basically that's the businesses, okay? So now, in terms of the challenges with the adoption of the Sand Dollar, the first one of the challenges we faced was erroneous public information being circulated. Persons not really understanding the purpose and how Sand Dollar works. And they're spreading these rumors, and they have social media now, and persons putting such things about Sand Dollar. And also there's some lack of confidence in topping up of your wallets, the individual wallets. You had some concerns here, there. Businesses also, they were having a challenge in when customers purchase Sand Dollar in the immediate transfer of the money to their bank accounts in order for them to see it. So those are some of the challenges. How did we go about addressing these challenges? First, we launched a massive public education campaign, making people aware of what Sand Dollar is about and how can you get the benefits of using Sand Dollar. Also, in addressing some of the privacy issues, the Sand Dollar platform, it provides a full end-to-end encryption, which means that none of the back-end users contain knowledge of the user's privacy keys. So it creates an amount of privacy for you. And also, in addition, we have a 2-layer secure data storage. With the first being enable capabilities for transaction. We have capabilities for transactions. And also, we introduced this distributed ledger that the panel before was talking about, which ensures that data accuracy and security. Because at the end of the day, you have all the transactions collated, and it can be shared, but only in the aggregated form. We don't share individual information. So those are some of the things we did in addressing the challenges in terms of Sand Dollar. But I should mention that when we first launched Sand Dollar, it was launched in December 2019, and then COVID came. So we had a massive campaign on, but then COVID came. So from March 2020, we had to cease no travel, whatever, to the different family islands. So that actually was a bit of setback for us. But then last year, when we launched in 2019, it was in a pilot phase. We were using one island in Exuma. But then in December 2020, we decided to just launch it island-wide in the entire Bahamas, although we were in the COVID environment. But sorry, it's fine. Since we resumed, the country opened back and we resumed operations, we have ramped up our campaign. And what we've noticed, because we have a designated Sand Dollar unit, adoption unit, and they go to the family islands, and they actually educate persons and businesses about the benefits of using sand dollar. So what we've noticed over time is that there's been a slight uptick in the adoption rate. But we had a setback in the COVID environment, but we were addressing that and we've seen some positive developments since we're back. Yeah.
Great. Thanks so much, Sharon. That's really relevant. I think the adoption issue is something that we're going to be very interested in talking about throughout this panel. So I wanted to turn next to Musa and just to tell us about the eNIDA, which was launched 2 years ago now. And I think eNIDA is very interesting because in addition to a central bank digital currency, you also have a fast payment system in Nigeria, the Nigeria Interbank Settlement System. And so could you tell us a little bit about the eNIDA itself, the motivations, but also how it interacts with this fast payment system?
Thank you very much. Just like you said, eNIDA was launched 2 years ago, and the primary objective was basically to fulfill about 3 key needs of the government. One, the government has embarked on a major project in Nigeria called the conditional cash transfer. Basically a project to, support the less privileged, by providing some assistance and all of that. And the question is, how do you provide this money and ensure that they are used to the right places, the purpose for which the monies were meant for? And so we were looking for a technology or a kind of system that will enable us to deliver that. And because of the programmability of CBDC, we were able to leverage on that to ensure that we can issue sectoral money, money that is issued to perform certain function within certain sectors. So for example, the government gives money to the farmers for them to use to buy fertilizers. And we want to ensure that those monies are actually used for those purposes and not for any other thing. So we leverage on CBDC's function of being programmable to, issue such money for those kind of activities. So CBDC was also born with the effect of supporting the government to implement some of their projects. The other one was also to reduce the cost of industry to serve. Cost of financial services in Nigeria was very, very high because everything was involved with banks and all of that. And so central bank stepped in to see how we can remove the intermediaries, thereby lowering the cost of doing transactions. And so CBDC was also brought in with the mind that the money was going to sit with the central bank, and therefore transactions will happen within the blockchain that is being run by central bank. And so reducing costs was also a major objective. The third one is also about printing of cash. It's very expensive to print cash. It takes money, to print money. And leveraging on CBDC, central bank can actually increase the seigniorage by ensuring that everything is done digitally, from issuance to distribution and bringing back to destruction. It's going to cost less because everything is going to be digital. And all this will translate to reduce cost of financial services. So basically, these are the 3 core objectives why central bank brought, central bank digital currency. And if you add all of this together, you see that the major objective is bringing down cost. All we do to make sure that we bring down costs, and that, helps to push the financial inclusion strategy of the bank. Nigeria has signed up to the Alliance for Financial Inclusion global objective of making sure that we reduce the number of those outside of the financial services. And we, Nigeria, we have an objective of making sure that we bring inclusion level to about 95% next year, 2024. So in order to fulfill this objective, we need to take away all the major deterrents to financial inclusion, of which high cost of financial services is one. So there's a hope that if we're able to use this effectively, the cost of financial services will come down, and that will push for more inclusion. What are those major deterrents or challenges that we face? Acceptance network. Because when people come to take CBDC, the eNaira, the first question they ask themselves is, where can they use it? You don't take the digital money only for you to put it in the wallet and be moving around. You want to use it. So acceptance point was a problem. The second one was collaboration with the commercial banks. The commercial banks were very suspicious of the central bank. They felt that, we're actually taking their intermediation responsibility. If central bank is now doing retail, CBDC, thereby interacting directly with the customers of the bank. And so there was this mutual suspicion of what the objective of the central bank is. So they refused to collaborate. they refuse to integrate. And you can't run any payment services without integrating with the existing infrastructure, which is already with the banks. And so there was no support from them. The third one was about literacy level. A lot of people, Nigerian publics, were also suspicious of why a government entity, the central bank, would want to run a retail bank. Because CBDC, running a retail CBDC is like running a commercial bank and engaging with the customers direct. And so people do not want to take a CBDC. They don't want to take the INR, because what they felt is that if they keep wallets with the central bank, it means the government will have access to all their transactions, especially the business outfits feel that the government will see all the transactions and the primary objective is to be able to tax them appropriately. So everybody was running away from CBDC. And then the last one was about infrastructure. We have power challenge, electricity challenge in Nigeria. We also have communication challenge in Nigeria. You don't have, the tele-density is still very low. You don't have it in all the nooks and crannies of Nigeria. And you can't run an effective payment system without telecommunication infrastructure. So a lot of people in the hinterland don't have access to telecommunications. So how will they then play with CBDC? Well, all in all, we've taken a step to make sure that in the future, we're going to have a very effective system by some of the initiatives that we have put in place. The regulatory sandbox to enable innovative ideas thrive in Nigeria, the open banking to ensure that the fintechs integrate with the commercial banks and provide rails to enable them to do some other creative ideas. And all this is packed in a document we call the Payment System Vision 2020.
Thanks so much, Musa. That's really, really useful. So we'll now turn to an advanced economy, the Canadian case. And in Canada, you're getting ready to launch the real-time rail in 2024. So we want to know kind of how does the real-time rail differ from the existing payment systems in Canada? What factors have influenced the timing of the launch? And how do you think it'll change the Canadian payments landscape going forward?
So I'm sorry to disappoint you, but we won't be launching next year. It's been a very complex implementation. So Canada basically has, at the moment, 2 existing national payment systems, of which Payments Canada owns and operates. So the one is the wire system, or the RTGS, which we upgraded to a new system in 2021, and then we've just moved it to us so earlier this year. So that's now best in class, but what we want to do is make sure that the RTGS serves its purpose for high value payments. We also have a retail batch system, which you would, I think in the States, refer to as an ACH system. So all the other payments besides credit card go through that system. That is called the ACSS, and that is as old as, in fact, I think it's a year older than I am. And it is basically a glorified spreadsheet. So it really is in dire need for upgrade. But what we're focusing on the moment, to your point, is implementing a real-time payment system. And the complication in Canada, and then the reason that I'm saying we're not launching next year, is because we haven't come off a blank slate in Canada. We have something that in the minds of the consumer is a real-time system. It's called Interac transfer. If any of you are familiar with it, it's alias-based. I just need your email address and I can send you money. Now, it's not immediate settlement. It actually settles next day between financial institutions. So there is some credit risk there. So the limits are pretty low. However, in the minds of Canadians, that's a real-time system, and it has very strong connectivity existing in the market between financial institutions. So we had to leverage that. We couldn't just build a real-time rail off on the side and then have Interac transfer that would confuse consumers and would not allow us to have a ubiquitous reach. So we're actually using Interac as a corporation. They're our vendor to build our exchange for the real-time system. So that's one part of it. The actual Interac transfer payment type is going to be the first overlay on top of that rail. And you then can have other banks or institutions plugging in directly into the rail as well as separate overlays. Now you've got, that's for the exchange. For technical reasons, we decided to split exchange from clearing and settlement. So we've got a separate vendor, VocaLink, for clearing and settlement. Now we've got a multi-vendor multi-bank. We have, as some of you know who deal in this environment, the big banks have big voices. So we're trying to corral an industry around a common goal here. And we're also opening up the system at the same time to PSPs. So you're now inviting competitors into the system as well. So it has become a very complex project. We've had some issues with certain milestone deliveries. So we're just revisiting that right now and rebaselining the plan. That's why I say 2024 is not the date. But we are, as Payments Canada, we're not a government agency. We're what's called public purpose. So what we do have to ensure is that what we do build is in the interest of the public. It's in the interest of all Canadians, not just the banks, not just the PSPs. So we want to make sure what we do build is right. And it's simply the utilities that people can build and innovate on top of that. So when we do launch, we want to make sure that it makes sense for the country and it has that future proofing to allow for cross-border trade, for CBDC use cases, et cetera, et cetera.
Thanks a lot, Robin. So we'll turn next to Ricardo. And in Brazil, of course, the central bank has launched a very successful instant payment system, PIX. And now you're working also on a wholesale CBDC project, the Digital Real or DREX. And so could you tell us a little bit about some of the motivations behind that? How do PIX and the Digital Real DREX relate to each other? And how does the central bank see the evolution of the payment system going forward?
Thank you, John. Well, we started studying the launch of PIX back in 2018. So by December 2018, we had the directives for launching PIX for remissed an instant payment in the country. So we started the project in 2019. In November 2020, in the middle of the COVID crisis, we launched it. It was a bit challenging. It was a short period. Besides, as you may imagine, incumbents had some thoughts, doubts in terms of launching PIX. But the thing is that we had this alias database, and the alias database was actually launched before PIX, which was important because it would be frustrating to launch PIX and you're being unable to actually send the PIX when it was launched. So it was important to launch the alias database prior to that. And besides, being the major institution for someone was as an issue, there was this most important aliases. One was your ID in the IRS, the Brazilian IRS, and another was your email. So they want to get sure that they have those aliases. And even big banks start to dispute who would have those aliases. And so they were doubtful in a moment, but then they were racing against each other. It helped a lot in terms of the momentum for launching PIX. And it was surprisingly a huge success. For instance, so it was launched 3 years ago. Back there, 0 transactions, and nowadays, last October, more than 4 billion transactions, which is a lot. Now it's PIX has surpassed debit and credit cards altogether.
And Ricardo, just for people's benefit, what percentage of the population is now using PIX?
Oh yeah, if we think of the adult population, we are near 160 million adults in the country. We have more than 142 million actually using PIX. So it's huge. It's been widely accepted, and nowadays it's funny to think of ourselves prior to PIX.
Very good. Yes. So I mean, again, we were talking about different examples of adoption, and so here we're nearly 90% adoption among Brazilian adults, which I think is a very impressive feat. And I know that in other countries, in Costa Rica, for instance, where Simple Mobile has been launched, another fast payment system is over 70%. So I think these are very impressive numbers that show that once these network effects take off, once a lot of people start using it, that it becomes self-reinforcing. And so now we want to turn to Aaron and think about, Aaron, the international experience, some of the examples you've heard today. Are there lessons from this for the United States? Are there risks or challenges or things that you would emphasize for especially the US regulators in the room?
Yeah, absolutely. I wrote a paper on this, actually. It was published by Wharton. It's up there. I looked at 4 cases. I looked at the UK PICs. I looked at China, who has a ubiquitous real. They leapfrogged from a cash-based system to Ali and WeChat outside of the banking system, ignoring cards. There's some very clear mandates, right? There's very clear lessons learned. Brazil mandated it. Brazil first offered the banks the opportunity to do it. The banks took a pass, then the government built it, and the government mandated its use, right? Similarly, in England in 2008, took them 18 months. I don't know how Canada or the United States is so much more infinitely complex than our friends across the pond, right? Because like they seem like a pretty big, similar country. They did in 18 months. At first, it was slow to be used. They put in a second directive. It had to be adopted, right? FedNow, when it came out, has less than 1% of insured depositories signed up. Even those who are signed up often in receive-only mode, no adoption. So if you want to make it successful, require it. You don't have to require that you use that clearing payment system. You can require that the funds be available and immediate, and you can let the institutions make up their choice. But the magic hand doesn't work when the financial incentives are not lined up for all parties. So, if I had to guess why Canada is having problems, is you're trying to make it work for everyone. And right now the system works better for some people than others. And there's not necessarily a Pareto improving situation. Lesson 2, the size of revenue made from the payment system mattered in terms of adoption speed. So for example, in Brazil, and please correct me if I'm wrong, because you're the expert here, but from what I understood, the industry didn't want to do it because they had high fees. PICs slashed those fees, but because it brought so many more people into the system, the net to the industry was closer to a wash than most people would have expected. I don't think a private person would have predicted this level of inclusion this rapid, right? Similarly, in China, the merchants refused to adopt cards. There were 20 million credit card readers in all of China in, I think, 2014. I think there are 20 million credit card readers in the DC metro area. I think there are 23 in my supermarket. And then I went to a gas station, I counted another 15, right? The merchants wouldn't do it because they wouldn't eat the fee. Ali and we came in, they said no fee. Wow, everybody did it, right? The US has a huge fee system. The Fed did something very interesting this week in trying to cut debit card interchange fee. Credit card fees are extremely high in the United States from interchange. You have overdraft, you have float, you have a bunch of other fees. So the size of the fee, the larger the fee, the slower the voluntary set of adoption. Third point, as it relates to this, has to do with the question of the CBDC element, which 2 countries have raised here. America has the world's largest CBDC. It's commercial bank digital currency. The core points I take in these things are questions about where commercial bank digital currency isn't working and why you need to swap the first C from commercial to central. That could be lack of access to commercial banks. That could be constructs on the value of the commercial banking system in the country. In the United States, I see I've yet to see a person make a compelling case for why commercial bank digital currency is falling short and a solution that central bank digital currency will do better in. If somebody has that, I'm open to hearing it, but I think we start with this concept that we don't have CBDC and then look at what CBDC can do. I think the right question is we have CBDC. What can the central bank do better and why would it be better, cheaper, faster, and more accessible than commercial banks? In developed countries, that could be a very different answer than in developing countries.
So I wanted to ask a question now and to get a little bit of interaction before we have to close. I mean, so for Sharon and for Musa, just quickly, what impact do you think that CBDC concretely or fast payment system could concretely have on financial inclusion in your jurisdiction? Do you think this could be a game changer?
Yes, I think for us, in filling that void, it would allow the persons that don't have access to banking service to be grafted into that fold. And that will help us. Also for us with Sandollar, I should point out that there is no transaction cost. It's free of cost. That's one of the stipulations. When we launch it, we actually insisted that it should be a service free of cost. So we don't charge, you don't charge you Sandollar. So we think that yes, it will help in filling the void that we notice in terms of the persons being unbanked. It will help the unbanked. We're hoping for them to become into the fold of being banked. That's all motive with financial inclusion for us. And so even with our, we're doing some upgrades to what we're gonna launch shortly called Wallet 202. And in that, there's some enhancements such as currently if you wanna be onboarded, you have to go to one of our authorized financial institutions. But in the upgrades, enhancements will be you'll be able to onboard yourself. You'd also be able to top up your wallet yourself, because currently you have to go to AFI to do that. You'll be able to top up your wallet yourself. And also for businesses, we're doing some updated features to allow them to see that when they do transactions with customers, for it to be immediately shown in there for you to transfer to your banking account. So we think with that, it would help us in our whole goal of financial inclusion. So everybody would have access to being part of the financial system.
I think there are two major issues that those who are excluded from the financial systems would like to solve with money. For cash, it's an instant payment, no clearing, it settles. Once I give you cash, it's final and irrevocable, the one that's solved. And so the high cost of financial services is also one major reasons why people don't want to put their money in the bank. They don't want a situation where they are charged different fees just for transacting or for paying for goods and services. And I think CBDC solves that problem in terms of lowering the cost of financial services, because a lot of intermediaries would have been removed. And when transactions happen at merchant locations, we charge zero MDR. So that encourages the merchant to accept CBDC. The instant payment delivers the trust that cash actually gives, because money is transferred and you see the value instantly. And that's the kind of trust that those that are excluded would like to see to encourage them to begin to use electronic form of payment. So all in all, it will help push the adoption of electronic payment and deepen financial inclusion for the country.
Great, thanks a lot. So we're nearing the end of our time, but I wanted to just ask in rapid fire, Erin, Robin, and Ricardo, if you could tell us, in your jurisdiction, what you think the future of payments looks like. Ultimately, in 5 years from now, what do you think that it should look like relative to today's status quo?
So in Thursday, if I get paid at 5 p.m. on this Thursday, I have no way to access that money inside my bank account until the following Monday or Tuesday. Friday's a holiday. That's horrific. That's also completely fine for me. I have a cushion, doesn't matter, right? But for the half of Americans who live paycheck to paycheck, the cost of that system, 70% of people at check cashing have bank accounts. The conversation in America has been fundamentally misguided by this question of inclusion versus exclusion. If you have a bank account and go to a check casher, are you financially included or excluded? I think the answer is both. So if inclusion plus exclusion is greater than 100%, you do not have a dichotomy, right? What do I think will be different in 5 years? Nothing. I see very limited change. As long as the wealthy are getting flooded with points, as long as adoption is voluntary, this is a sticky situation. And I am not aware of that many places where there's been substantive change without mandates or requirements.
Thanks, Erin. And as an American, I hope you're wrong, but I appreciate your honest take on this. So is there more hope in our northern neighbors?
We'll have real-time payments in 5 years. No, I think we'll see the conversions of real-time digital ID and more data with payments. So I think Canada's payment systems coming from South Africa always used to certain things and kind of more innovative payments. So I'm hoping that we'll start to see that with a rail that allows that. I don't believe we'll see CBDC. Canada's taken obviously a very conservative approach to this, then only if it's really, really needed, which I think it'll take a strong use case to convince the Bank of Canada that it's necessary. So I don't think we'll see anything like that, but I do think we'll start seeing some innovations on having a true real-time system and more ubiquity across Canada.
Okay, let's move to Brazil. You guys have been pioneers, so what do you think this looks like in 5 years from now?
I think that you'll see many more use cases in PIX. We see a P2B is still growing and will grow very much when we have NFC, near field communication, embedded into PIX payments. We already see bill payments and direct debits will be launched next year. Besides, and this is great because we see the cards industry is actually evolving really fast as well. And, you know, for several years we had NFC POS enabled, but no NFC cards. And then with PIX, they launched the NFC cards and the adoption was great. And I'm a heavy user of it, but you know, competition is always good. Besides, maybe we will watch the initial life of Drex in terms of other financial services using the CBDC, the DLT, and the market participants developing services in those platforms. And that's what I expect. Thank you.
Thanks so much. So I think it's been really interesting to get the international perspective and to hear, you know, about some of the pioneering work in different jurisdictions. Thank you everyone for sharing your perspectives. This is really appreciated. So now we'll close the panel here and we'll come back at exactly 3:30 for the next panel. So that leaves us a few minutes to go for coffee. Thank you everyone for taking part.
to the very last panel of today, governance of cross-border payments. Why do we talk about cross-border payments? The thing is that improving cross-border payments, it's a key priority for G20. And I do believe that fintech ecosystem players, they have a responsibility to complement to this objective. Across the globe, we have roughly 100 fast payment systems, but majority of them, they are not interlinked. If we would have them interlinked, we could really improve cross-border payments. However, interlinking privately owned and public sector owned fast payment systems, it's very tricky, to put it mildly. And the new CBDC systems, which were discussed in the previous panel, it adds even more complexity to that. You know, when we have many stakeholders, it's so difficult to reach consensus, to make decisions. And as we had one speaker from multi-jurisdictional entity today saying, you know, when you have many stakeholders, it's a true headache to reach good decisions and good outcomes. So governance here comes in. Despite the fact that we have governance and oversight frameworks which are relevant today, fast payment system interlinkages, CBDCs, they include more complexity. I'm very happy that I have 3 excellent speakers today to unpack this all for you and for us. On my left, I have Maria Teresa, Senior Financial Sector Specialist from World Bank. Next to her, I have Kah Kit Yip from BIS Innovation Hub in Singapore. And last but not least, I have one and only virtual participant of today's conference, Mehdi Mana from Buna. He is CEO of Buna, which is multi-currency cross-border payment platform established by Arab Monetary Fund 5 years ago. So without further ado, I would like to turn to Maria Teresa and ask about fast payment system interlinkages. As I've said, we have roughly 100 of them across the globe, but most of them are domestically focused, and cross-border operation currently it's not resolved, so to say. Why do we have such difficulties with cross-border payments? How could interlinking fast payment systems help to meet G20 targets around cross-border payments?
Thank you, Martinez, and thank you for having me here today. Yes, it's true, only a few fast payment systems are interlinking across borders, and there are a couple of reasons for this situation. So first of all, FPS implementation has been recent, relatively recent, I would say, and gradual. So initially, fast payment systems are very much focused on enabling domestic person-to-person payments around the clock. But what we have seen, and we have also heard in the previous panel, is that the payment types and the use cases have been increasing dramatically over the last few years, from P2P to B2P, G2P, and B2B payments now. And the connectivity across border is just the last extension of FPS services and functionality. The second aspect that we need to take into consideration is the fact that cross-border payments are inherently more complex than domestic payments because of several, well, in the payment itself, because of FX issues, AML checks, and currency controls in some jurisdictions, but also because of the complexity that go into building these interlinking arrangements, from identifying a clear and cogent business case to finding an agreement around the design options of the interlinking arrangement consistent with risk management expectations, particularly for currency conversion, the allocation of risks for FX, liquidity management, credit risk management, and some of the design options. And then we also have misalignment, business rule and technical standards, market conventions, around, for example, a proxy addressing or around turnaround time for transactions. There are a lot of these, again, rules and regulations that would have to be aligned across borders. And also legal and regulatory frameworks may be misaligned. But look, we have, I think, a great opportunity. Fast payment systems have a lot of traction at domestic level. There is also the increasingly digital economy. The digitalization of the economy is also placing a huge demand on low cost, fast, and convenient cross-border payments. Increasingly, the digital trade is the global trade. So these are this opportunity that we see. A fast payment system have a lot of traction. We support prioritizing fast payment systems for the cross-border agenda. It's true, we have also other type of arrangements emerging. We heard about tokenization, CBDC, smart contract, just to name a few. However, there is a need to further elaborate on these arrangements and also find a way to better integrate between these arrangements and fast payment systems themselves.
So it sounds that situation right now is really problematic with cross-border payments and interlinkages of fast payment systems. On the other hand, at the same time, it presents a perfect opportunity to do something big and have very good results, like Maria Teresa just said. And now we have another speaker with a big vision how this could be sorted out. Kit, I would like to ask you about BIS Innovation Hub project Nexus. I know that you have been an important part of that project. And it is a blueprint to connect multiple fast payment systems. It's a vision. How would this work in practice? Why would making this vision a reality be important for the fintech ecosystem?
Thanks a lot, Martinez, for inviting me to this panel. So I think I would echo what Maria said just now, that the fast payment system is an open loop infrastructure that we can leverage on, not just for domestic payment, but also for cross-border payments, especially in countries where there are already a steady range of use cases and also rapid adoption. If you can link up the fast payment system and use it to facilitate instant payment system, it could become a game changer when it comes to improving the cross-border payment system that we have right now. So bilateral fast payment system linkages are already in existence. For instance, in the Southeast Asia region, Singapore and Thailand have linked up their fast payment system, and they have managed to reduce the cost of payment system from 5% on average to below 2%. And I think we celebrate these successes, but building a bilateral linkage typically takes 2 to 3 years. And that is due to the time taken to address the technical connectivity as well as to streamline the legal and regulatory frameworks between 2 countries. So 3 countries will require 3 links. 20 countries will require 190 links. So the number and complexity will become disproportionately larger if we only leverage on bilateral linkages. And that is where I think in 2021, the BIS Innovation Hub came up with a blueprint to link up the fast payment system, not in a bilateral manner, but in a multilateral manner, such that payment system only needs to connect once in order to access all countries and corridors. So we did a proof of concept last year, and this proved that the concept of a multilateral network of fast payment system is technically feasible. But the real challenge, I must say, lies in the elephant of the room, which is the issue of governance. How do we get multiple countries to jointly own, develop, and run a multilateral network of instant payment system? How do we balance between the public and private sector interests? How do we foster inclusivity, but not at the expense of agility? So these are some of the critical issues that are standing between the success that we see in domestic fast payment system and the promise that it will bring in the cross-border space. So this year, in 2023, the BIS Innovation Hub in Singapore are collaborating with 5 ASEAN countries who have set up a vision to connect their fast payment system by 2025. So we are fine-tuning our Nexus blueprint to account for not just the technical architecture that is production ready, but also to develop a working governance framework. And in addition to that, a viable commercial model, such that when the decision is made to go live, then we would have all the ingredients that would help us realize the vision of an instant network of fast payment system. Yeah, so that's broadly what we are working on right now, but happy to provide the details in the subsequent part of this discussion.
Thank you, Kahkit. So 5 Southeast Asian countries will be building interlinkages in the next 2-3 years. I would like to turn to Mehdi. I understand that countries in your region are already building this, and Buna is a key component of that. Could you tell us about your experience so far, and especially when it comes to building consensus among the included countries? How difficult or easy it has been for you? How you came up on top successfully out of these negotiations?
Yeah, thank you very much, Martinez. Thank you very much for inviting me, first of all, for the session today. And sorry if I was not able to be with you, but it's still a pleasure to contribute to this discussion, which is of critical importance. Yeah, in our case, in the case of Buna, maybe I should distinguish between the two different dimensions. First, the intra-Arab one. This one was quite easy to achieve consensus because Buna is a central bank-driven initiative, so it has been initiated and sponsored by the Council of Arab Central Bank Governors. So the consensus was there at the initiation, at the inception of the project, with the backing of all central banks from the Arab region. And that support has been a constant throughout the development of the initiative, and still the case today during its deployment. It's a different dimension when you go to the extra-Arab dimension, because Buna is not really only a regional initiative. It has always had in the back of the mind of the sponsor of the vision of Buna to also better connect to the Arab region to the rest of the globe. And here comes the interlinking with other regions. So here it's right. We are facing the same issues that, as mentioned by Maria Teresa and Kahkit, and difficulties to implement this initiative. We have a few in our pipeline. The most recent one has been announced last Friday with the State Bank of Pakistan to interconnect our fast payment system with Rasht, the fast payment system operated by the State Bank of Pakistan. So that one ticks all the boxes. It's important for us because the corridor between the Arab region and Pakistan is a very sizable one. So it contributes to our volumes and to our traffic, and therefore to our cost recovery. It's absolutely meaningful for our participants as well. We want to offer them a single window for all their cross-border activities, not just for the Arab region. For them as well, the corridor to Pakistan is important. So if they can manage the Arab region plus Pakistan plus other jurisdictions through a single window, this makes absolutely sense for them. If you look at it from the Pakistan angle, it's also something that is of a particular relevance. The economy in Pakistan is heavily dependent on remittance. More than half of it is coming from the Arab region. So you see, in terms of alignment, everything is there. Also the fact that we are a central bank to central bank. So in terms of risk management, in terms of compliance, here we have full alignment. So we need to ensure all these aspects from both sides to move ahead, and to move ahead with confidence that it's worth the investment. As mentioned by Kahkit, this interlinking today costs, on average 2 to 3 years, correct, if you are optimistic. But in my view, that should change. That should change. I don't think that we can conceive this as a model for the future. So such a heavy alignment is needed because it is complex to deliver this interlinking. It takes 2 to 3 years. But if you bring it down to 2 to 3 months, the equation will be totally different. So we have to look at it. I think this should be our ambition, is to see how we can make this interlinking initiative more, say, harmonized more standardized to implement them in a quicker and a more efficient way. And therefore, such a huge alignment is maybe not needed, or at least not needed for long. It will be just a question of opportunity. I can make the parallel with the participation in a payment system. Today, in most of the cases, when a participant is eligible to a payment system, it's almost there forever. In Buna, we had to take a different approach because of the risk dimension and because of the cross-border dimension. So our eligibility criteria are very strict, but we consider the fact that they might be met at a certain point in time and not be met anymore after a while. And therefore, our criteria for the participation, we are revising them, participant by participant on a regular basis, and our rules foresee the possibility of suspending a participant, which we did recently. So we suspended 12 of our participants because they were not meeting the eligibility criteria anymore. So that would be, to some extent, the same when it comes to interoperability or interlinking with other payment systems. If there is an opportunity today, and it's not too complex to implement the interlinking, let's go for it. If tomorrow there is a misalignment, and it's easy and not too complicated to switch off the link for a period of time or differently, why not? Why not? So the agility that has been mentioned, I think that we have to bring it to that dimension as well.
Many thanks, Mehdi. Indeed, if we can smooth and make faster interlinkage arrangements to actually reach the result of successful interlinking, we can recoup the investment faster. And then it means that we can be much more agile. Maria Teresa, what's your take on reaching the consensus when it comes to involved jurisdictions and their alignment of strategic and economic policy priorities? Is that needed? To what extent is that a precondition for successful interlinkage of payment systems?
I think to some extent, Mehdi made a very, very important point, which I want to highlight again. So there are certain aspects of interlinking where central bank support, public sector support is especially important, and governance is one of these aspects. So there are two notions of governance. So governance can be thought of as the set the relationship between the owners, the FMI, the payment system managers, stakeholders, participants, and relevant authorities, but it is also the framework within which a payment system and interlinking arrangement operates. So that is the institutions, the laws, the regulation, the policy aims, and a number of other factors within which that interlinking arrangement will have to operate. Governance is especially important for an interlinking arrangement to fulfill public policy objective, as the principle for financial market infrastructure teach us. And it's also something that could be very complex because it can touch upon sovereignty issues. It can touch upon long-term payment system strategy issues. So that's where I think the support of the central banks of the public sector is especially important and needs to be there in order to align the stars as we're just talking about. In the second point that is implied in what Mehdi just said is the fact that regional integration initiatives can provide that anchor for aligning key policy aims and in strategies. And they can do that in a few ways. So first of all, regional integration initiatives, they would have that vision within which then you can frame the vision and the plan for a multilateral platform or an interlinking arrangement. This is not just the case of Buna, but it's also the case of PAPS in Africa and so on. Second, a regional initiative would have those working groups within which then the different stakeholders can discuss how to develop an interlinking arrangements. They can align incentives. They can potentially also draw from in terms of ensuring the leadership and the management for the development of the interlinking arrangement. And also within a regional initiative, it might be a little bit easier to agree around, for example, the legal structure or the ownership of a new entity. And let's not, and I think that the point here is that if you use this anchor, then what is developed within a region, can become a little bit of a regional hub for global connectivity. So to allow participants access to other currencies and to extra regional markets. And second, if it's done on a bilateral basis, it can also become a starting point for developing a multilateral framework along the lines of the flexibility that Mehdi has mentioned. And my last point here is that these multilateral frameworks need to be flexible enough in order to ensure that emerging market and developing economies can onboard onto these frameworks based on certain minimum criteria, and then eventually they can onboard more and more functionalities as they mature in terms of meeting the requirements of the framework.
Thank you, Maria Teresa. And now, as we have 5 minutes left, I have one question to Mehdi and one to Kahkit regarding, for Mehdi, some practicalities of current day, and for Kahkit after that, look into the future. So regarding the practicalities of the day, Mehdi, how can you appropriately involve stakeholders and consider their views when making decisions in Buna, for example?
Yeah, thank you for the question. So I think it comes back to the cooperation between public and private sector, because very often we have payment systems that are either operated by the public or the private sector, it depends. And therefore, depending on who is operating, the involvement of the other side might be more or less complicated. I think here as well, we have to think in a very open way, really not just thinking out of the box, but also maybe doing and operating out of the box. So very often when a payment system is operated by the public sector tends to keep control, to keep the upper hand in the governance, which might not be totally exclusive or open in terms of governance. And vice versa, if it is a privately operated payment system, in most of the cases, there is not even involvement of the public sector apart as in its role of supervisor. So here in Buna, we have been very, very open with this. So again, Buna is a publicly driven initiative, but we see it as again, it's for the public good. The publicly owned initiative doesn't mean that we need to keep the control from the public sector forever. We are currently in a transition phase that is taking different shapes. First of all, our board of directors, it's exclusively composed of CEOs of banks, of private sector, which are the user of the system. So it's really, we are handing over the initiative from the private to the public sector. In addition to that, we have launched our advisory group, which is more inclusive, because the board, of course, is of let's say a manageable size, so just 5 banks are involved, but they are the majority of the board, plus 3 independent directors coming from outside the region. But our advisory group is large and expandable, I would say, so we'll continue increasing it whenever we have more participants. And here again, it's mainly exclusively actually composed by our participants. We discuss with them all options that are relevant to them. So whenever there is anything of relevance to the users is discussed in that forum. We gather their feedback, and it's really taken as a basis for the decision of the executive committee, first of all, and then the board, which is once again composed by the user. So this is how we see it. So if we align with the vision of the public sector of delivering something that requires the initial push of the public sector, but we see it really as for the public good. This is our view. It has to be fully, at a certain point, committed or transferred to the participant, including in terms of shareholdership. Yeah, okay.
Thank you, Mehdi.
Thank you.
It's good to know that you have this participatory decision-making. And thanks for joining this quite late evening for you. And I have a last question that I want to pose to Kahkid here. It's related to the discussion we just had on CBDCs. So many central banks are experimenting and building new systems, also including experiments on multi-currency CBDC platforms. What kind of new governance challenges do we see in this area, if any?
I think in general, the governance challenges for a multilateral platform would be rather similar, whether it is in the case of a multilateral fast payment system network or a multi-CBDC system. But having said that, I think the differences would lie either in the degree or in the additional consideration that may need to be taken into account when you factor in the distinct differences between these two systems that we are talking about right now. Let me offer you 3 examples. The first one would be, I think, in terms of relinquishing control. So in the case of fast payment system, it is typically operated by the private sector or a combination of public or private sector. And it involves the transfer of commercial bank money. And I think we are all very familiar with the notion of a 2-tier financial system. But in the case of a CBDC, a multi-CBDC platform, the ledger are typically the sole control of the central bank. And if you look at it from a multilateral perspective, the idea of relinquishing some of the control to a multilateral operator is not a concept that is familiar to central banks. And hence, I think in order to reassure the central banks that they still have sovereignty and also control in their own ledger, we need to build in the relevant governance and technical controls. So in the BIS Innovation Hub, we have run a few experiments. Project Dunbar was a project that we also look into the issue of governance. And that's where we think that it is important to define very clearly what are the remit of the operator versus the central banks. So issues like the life cycle management and access control for CBDC has to be the sole remit of the domestic central banks. So this would then, provide the reassurance to the domestic central banks in wanting to join a multi-CBDC system. The second area that we'd like to highlight would be in the form of access control. Now, CBDC, when used in a cross-border context, may raise certain complexities. For instance, it may, for emerging countries that have capital flow management, having non-resident access to CBDC would then perhaps introduce risks that may complicate the capital flow management. So in that regard, there needs to be governance policies that is put in place to regulate the access of CBDC to non-resident or the use of domestic CBDC for cross-border payments. So that is the second area. And I think the last area would be in the area of data protection or data sovereignty. So in the context of CBDC transactions, if the data is stored in a single cloud environment, I think that would introduce not just national security, but also operational resilience issues. So while data protection issues also exist in the case of FPS interlinking, I think in the case of a multi-CBDC platform, more would need to be done to ensure that sensitive data is isolated, stored off-chain if possible, and to leverage on some of the technologies that we talked about today, like the zero knowledge proof, in order to ensure that while we still allow cross-border payments, but we insulate it against unintentional disclosure of sensitive personal data. So I mean, these are evolving matters that would merit greater experimentation and also discussion among the experts and also public and private sector stakeholders. But it is something that we also work collaboratively with the industry on.
Many thanks, Kahkid. Indeed, it seems that there are a lot of questions which have already been sorted out when building the current governance and oversight frameworks. but there are so many questions looking into the future, and they're very curious about that. I would like to offer a big round of applause to our speakers. And Zainab, if you could pose the wrap-up slide. So the wrap-up is that instead of me offering any conclusions of today's conversation, yeah, I would like you to scan and give your conclusions to us. So there is a QR code for a short survey of today's event. Thanks very much and see you later on.